When a trader looks at the chart, he needs to safely identify the structure for the market and when the market is most likely heading. And trader can accomplish it by using price action tools and follow the price action rules. And when we look at the chart, what can we see? We can see that the structure for the day is a trading range, and we can see that there is a big move down and there is a big rally up. But the most important thing, I want you guys to focus your attention to the left side where the opening of the overnight session was, and you can see a gap. And these gaps act as a magnet, and price a lot of times will go and will quickly fill the gap. So once the price is coming off the low and is rallying up higher, your first target for the day that the price may reach is the filling of this gap, is that the price of this gap is most likely going to be filled. So now that we know that the price is most likely heading higher, we need to safely identify the structure for this trend because we want to follow the trend line rules. And we can see that there was a shortened break for this shortened trend line and there was a new extreme. So after that, we are expecting correction or straight up reversal following the trend line rules. There's a two-legged pullback down because market likes to move in pairs of twos, and two-legged pullback with the proper market context at the proper key entry point is a high probability setup. But market didn't reverse and instead continued pushing higher. So you guys can see I selected a spike and a channel pattern formation, and you guys can see I'm using this swing right here and this swing right here to find a confirmation for the trend line. You can either use this trend line or you can use a trend line like this from these swings right here. You guys can see it has triple confirmation, which generally tells you that the structure for the market is valid. Okay, but the reason why I don't like specifically using this bigger pattern is because the upper half of this channel is completely empty, and it is telling you that this channel is about to tilt over and is most likely not going to be acting as I would want to. So for that reason, I'm sticking with the shortened one because this represents the structure much better. And we have a break for the uptrend, and we have a move to a new extreme. And notice where we found our new extreme. We found it at the resistance at the very top. This is where the opening gap started, and this is the high for the day. So before you start trading, you need to identify the highs for the day and lows for the day, as they will come into play a lot of times. So once price created the break of the channel and created a new extreme form according to trend line rules, you expect correction or straight up reversal. But since you are at the very resistance, you can even get a reversal. But how do you recognize reversal? Well, you're going to recognize it by a reversal pattern. The price needs to push first below exponential moving average and give you a failed second entry long below exponential moving average. Because second entry long is a high probability setup on its way up. But right now, after market created a break and a new extreme, indicating that the bullish uptrend is no longer in play, we expect for price to reverse. So any second entry long right now is going to be a trap. So as the market is reversing lower and reversing lower, you're right now expecting for price to either correct or reverse, and you're expecting to get a second entry short. And you guys can see market created a new low, and there was a first entry short, pullback higher, second entry short right here. This is the second attempt by the bears to sell the market after new extreme was formed. So this is the first high probability setup when it comes to following price action rule and human psychology, because price pushed below EMA, created two-legged pullback to key entry point to the exponential moving average, and this is the first high probability setup for the day. I didn't take this setup myself because when I looked at it, I had a micro break and a micro new extreme of the downtrend, and I had a little bit bigger trend line, wasn't really confirmed yet. When I'm looking at the bigger trend line, I'm using the first two swings. There's a lot of times when you're expecting a bigger pattern from the very first two swings of the beginning of the move, that's how you're going to identify the channel. So keep that in mind because we will come into play to these first two swings. So this was the first two-legged pullback and also a failed second entry long. But as the price is right now pushing lower and lower, and we can understand that the structure is truly bearish, so our goal is to look for second entry short or failed second entry long again. So market created a new low, reversed, and there was a first attempt to sell, failed pullback higher because first entry is not a high probability setup, and there is a second entry short. You guys can see the same repeat pattern, two-legged pullback at the key entry point, and now you even have a trend line that is right now confirmed. First two swings right here, you notice how it fits off the bottom, and you can see that the EMA is holding price again. So this is a second entry short, high probability setup. Also, after a two-legged pullback, you can reset the count. So this is a first entry long failed and the second entry long failure. And this is a high probability setup. This was the pattern that I attempted to take today. Unfortunately, this happened so quickly that you almost didn't even get a chance to enter this trade. But this is how you identify the structure. You can see that the uptrend played out. You take into consideration the bigger picture. This is a range. So you identify the key level, high of the day. You identify the gap has been filled, break it in your extreme, and you know that the market, if it's pushing below EMA, is reversing. And now you're looking for the simple, easy setups to like a pullbacks at the key entry point. Now you take a look how EMA is pointing lower and the steeper trend line is looking valid. It's getting confirmed at the bottom. So our job doesn't stop there. We still look for second entry shorts or failed second entry long. New levels form, first entry short, pullback, second entry short. Repeat pattern of these two patterns. Why I didn't mark this setup? Because it's not at the key entry point. This is a tool like a pullback, but just because it is a second entry short with the direction of a trend doesn't mean that it is going to be a high probability setup. Context is good, pattern looks good, but it's far away from EMA. It's not even touching the trend line. So for that reason, even though this worked, you cannot cherry pick. You have to follow the rules and trust the process. And this was far away from both key entry points, and you cannot execute this. You have to sit on your hands and be patient, because the next time you enter right here, you're going to get stopped out and you will be wondering why you get stopped out here. So as the market is pushing lower, you guys can see that this is clearly now a proven downtrend. This is a bearish structure. EMA is pointing down, trend line is being present. You guys can see you can be tempted to use a Fibonacci tool and you can have a 50% retracement. Forget about Fibonacci. The price action can tell you absolutely everything you need to know without any use of crutches. Market created a new low. So when I'm watching this, I'm still looking for the same thing as I was looking right here. I have a new low, I have a first entry short, pullback, and I have a second entry short, and this time it managed to touch the EMA. And look at the signal bar, big bearish reversal bar. This is a good indication of bearish momentum. And also, once the price is pushing lower, notice the shortened trend line, and there is a break for the trend line because price closed outside, attempted to go lower, and created a new extreme. So this told me that this shortened trend line, at least temporarily, is over. So I'm safe to sell the second entry short at the key entry point. Also, this is the first break of this downtrend, so I expect new extreme to be formed. So this is my first trade for the day, quick easy scalp, and price suddenly reverse and bounce higher. Remember, I'm not predicting a long-term swing. All I'm interested is to catch a quick scalp. I'm holding a runner, and if I get a runner, this is a nice bonus, and I hold it because you don't want to leave money on the table. And in this instance, the runner was instantly stopped out. So you enter one tick at the close. You enter at the close once it trigger one tick below this bar, and your stop loss goes one tick above this bar right here. Market pushed higher, so you're sitting patiently, because when you're watching this right now, you have a break, you have an attempt to create new low, and you have a strong push above EMA. So when you're watching this, you're probably expecting a little bit of a bullish correction. You're expecting a little bit of a trading range. You're definitely not expecting a strong move below EMA like this. So once you see a strong move below EMA like this, and it nicely confirmed the trend line, this is how you know that the downtrend is probably resuming again, because you would really expect a stronger correction and you have such a steep rally. And take a look what you have. If I'm going to zoom down the price action, why do we mark the highs for the day and the lows for the day, the key levels? Because that's it, that is the target that price is most likely heading. So when I'm looking at the downtrend like this, okay, when I'm looking at the downtrend like this, and I can see that this is the low of the day, this is my target. I expect for price to go all the way up to here, all the way down to here. Okay, so only thing you need to use is a price action. You don't need to use anything else. So as the market is pushing lower, you guys can see how the trend line is holding nicely at the bottom. So you got a bearish structure. Exponential moving average still keeps pointing lower. So price created a new low and created a first entry short, push higher, and created a second entry short. So once again, this is new low, first entry short, second entry short, and a first entry long pullback, second entry long failure. But you don't go short here for the same reason you didn't go short here. You're far away from EMA, and you're getting short quite at the very close to lows. You're just being patient because you're just coming off the low of the channel, so you can hit and go to the other side. But you guys can see what would have happened. You would have had a losing trade. That's why you don't enter here and you don't enter here. You wait for price to pull back to key entry point to EMA, because that is where the high probability setup will occur. When I saw the second entry short and I saw it failed, I anticipated a double trap, because that's how a lot of times market will give you additional entry. When the second entry short forms far away from EMA, or is a bad signal bar, or there is a trend line in the way, price will tick higher, will stop everybody who went short on the second entry short too early, so they get stopped out, and everybody who's going long on the reversal pattern, or quote unquote reversal pattern, below EMA is going to get stopped out again. So people went short too early and they're going long too early, but there was never trigger for double trap and market just reversed higher. All right, so you're going to draw the short-term trend lines. There is a break, there is a new extreme, and you guys can see you have a strong push below EMA, which is now 100% confirming this bearish downtrend. So once the downtrend is bearish like this, you're still looking for the second entry shorts at the key entry point. So market is pushing lower, new low, first entry short, pullback, second entry short. But take a look at the strong bearish bar. You're going short directly into the lows at the very low of this move, and you're still not quite close to the EMA. Had this bar been a little bit smaller, this entry would have been better, but you cannot go short. It didn't even trigger, so you scratch it, you don't even worry about this. I thought we may get a trigger. So when you see a situation like this, okay, you don't even enter because there is no trigger below this bar right here. This bearish bar didn't get a trigger below. The price didn't tick below this bar for entry to be triggered. So instead what you do is you're going to mark the congestion that it is, because you guys can see this is a 10 bars right now going sideways. And this is a congestion in the market. This is a consolidation area. And the way you trade these consolidation areas, you don't enter in the middle of these. You wait for price to break out of these congestions. And if it breaks against the direction of the overall trend, you can fade the breakout and take the entry. So as the market is breaking to the upside, you guys can see false breakout to the upside, exponential moving average keeps holding price, and price reversed and push lower. This is a textbook example of a failed breakout out of a congestion with the direction of a trend. All right, but this signal bar is gigantic, stem at the bottom, and you would go short directly into the lows. So from a money management perspective and risk to reward, you cannot enter here. What you can do, you can wait for break below, put your limit order at the half of the bar, and you would have never got even close to being filled. But honestly, when it's big like this, and when it's close to the lows like this, you don't even want to enter. Had the bar close somewhere up here with enough room to these lows, because you need to hedge yourself, you have enough room to these lows, this would have been a great failed breakout with the overall direction of a trend. But you guys can see how powerful a simple price action is. You don't worry about all the weird first entries and selling at the bottom. No, you wait for price to correct in the fashion of a high probability setup to the key entry point. So once this is a downtrend pushing lower, and remember, this downtrend has yet to be broken. So this means that there are no long opportunities. Don't even think about picking up bottom. Don't even think about picking up some short trap. You just wait the corrections out and you wait for price to give you a good setup to sell. So as the trader is watching this, there's a new low form, okay? And there's a first attempt to sell, pullback, and there's a second attempt to sell. There's an uptrend, break, attempt to create new extreme, but a lot of times you don't even get a new extreme per se. The attempt is close enough. Why? Because the key entry point is holding. And when I see a second entry short like this, I see a big bearish bar at the EMA. Notice how EMA is holding price. This is a second entry short with the direction of an overall trend. This is where I go short. Once the trigger one tick below, I'm going to drop my limit order, and I would have gotten stopped out. And this was the exact trade that I took today, and I got stopped out here, and this trade was completely fine. I followed the rules, and it makes even no sense to think about this. Every strategy has a losing trade, so you just shake it off and you get patient and you wait for the next setup. There's no point in thinking about this. Take a look. Second entry, second entry, second entry short. All of these second entry short works and one failed. So that comes to the territory of the strategy. What could have helped you here is when you come from the bottom of the channel, you're probably heading to the other side. And when you have such a strong bullish momentum and you come from the lower half of the channel, you really expect a little bit stronger correction. So advanced trader can recognize this. But if I'm going to skip this entry, I can pretty much find a reason to skip any other entry, because there is always something about the pattern. So I don't want to complicate my life. I just want to follow the simple strategy. So I just gonna take second entry short. If it looks good, I took it, I got burned, and I was 1-to-1 and no problem. I'm just waiting patiently, and I wait for price to give me another good high probability setup. So right now you cannot enter because market is in a sideways consolidation. And take a look what happened. There was a new high formed, and this was a double trap, which was tempting to take, but once again, it was right into these lows. It still would have survived because your stop loss goes one tick above this bar right here. But there's a new high, and there's a first entry long, pullback, second entry long. And you know that if the structure is still a strong bearish downtrend, the second entry long is most likely going to trap traders going long too early, and somebody went long directly into exponential moving average, into top of this small little congestion. And this is now a failed second entry long with a great signal bar, and EMA has been holding price. so long. I didn't take this trade. I really wanted. In fact, I tried to enter this with the limit order and it got quickly. It didn't even almost tick back because it first ticked back without breaking lower, and once it broke lower, it completely took off. So there was no chance to enter this. But also this is sort of like a second entry short. If you reset the count here, first entry short, second entry short, first entry long, second entry long failure. So this is a great entry. And what I like, when I take a look at the 2500 tick chart, this is what I saw. I saw that on 2500 tick chart, price nicely confirmed the trend line that is really holding strong. So once I saw this, this is how I knew that I'm probably safe to enter at the congestion and at the EMA. But I didn't get in. I had to watch it to go without me. That happens. The powder trading market is sometimes too fast that even with a stop order, if you're not quick enough, you may miss an entry. So, but you have to make sure you're trying to catch these entries, because what you cannot do, you cannot skip the good entries, take a losing trade, and keep missing the good entries. That will not put the math on your side. You need to be trying to execute as much as you can, but this was really hard to enter even with the stop order. And take a look what happened. Not only a high probability setup, breakout of a congestion is when it breaks higher and pull back, you fade it with the trend. When it breaks lower, you're not fading it because you will go long in a downtrend. So you don't want to fade this breakout to the upside. Instead, what you want to do, you want to wait for additional way to enter a congestion. You wait for price to pull back out of the congestion and pull back, you want to break out of the congestion and pulls back and creates a breakout pullback pattern and a lower high setup that will confirm breakout of this congestion. And it confirms the EMA keeps holding price and the structure is still bearish. So you're still thinking and looking for opportunities to go long. But take a look at the signal bar. It is a little bit of doji bar with 2 ticks of a bullish body. So if I'm on a lower high, I need at least some sign of a bearish momentum, preferably bar like this or like this. Just really give me something bearish, but not a bullish bar like this. And the next bar that is bearish already created the scalp and is already close to low. So you cannot enter here, but this would have been a great breakout pullback pattern. I'm going to mark it just as an example. Next time you get a better signal bar, because it broke out, pulled back to the breakout area, previously tested it, lower high setup, downtrend is still strong bearish. As the market is pushing lower, you have a new high form, first entry long, pullback, second entry long, failure. And even though this would have worked for a quick scalp, this is not a great entry high probability that is according to rules, because it's once again very low. You're going short at the very low of this entire downtrend. Into these lows, you have no room. You always want to wait and put odds on your side. You want to enter on these pullbacks. You want for price to pull back to the key entry point that you predetermine. And that's where, you know, the sellers jump on board. Weak traders are trying to chase the market and they're shorting it as the market is pushing lower like this. Smart traders are just waiting for price to come to them and to the key entry point. So market is pushing higher. There's a new low. First entry short, little pullback, second entry short, but same story. Big bearish bar without any room to these lows right here. I cannot go short right here. Even though the key entry points are holding, I cannot take a first entry because it's a first entry, and I cannot take a second entry short because it's already down here. Take a look how the bottom of the channel is starting to get empty. The trend is starting to waver, so it's probably time to pull back. So there is no good entry at this point on right here. And now that price broke, what do? Do you look for bulls? Do you look for buying opportunities? No, because according to trend line rules, after there's a break, you expect for price to create a new extreme. But just because you have a break, that doesn't mean that you start blindly selling. No, you need to let the price action rules play out, because there are people taking profits, there are people who are going to go long too early, and you need to give them room to play out. So as the market is pushing higher, you need to find and draw the short-term trend lines again, because price action rules apply for the short-term trend lines again. So you don't use it just to go long. You're not interested in buying. You use it to wait for price to create new extreme of this uptrend break, new high, and now you know that now you're safe to be selling. After price created a break and new extreme, you know that it's okay to sell. What you're not going to do, you're not going to draw a trend line wider like this. Why? Because the bigger pattern is down and we're not expecting wider reversal. This was just a temporary correction, profit taking, and the way you can recognize that the price is truly resuming the bearish momentum, you wait how you close below EMA or you're going to push above EMA. I see a new high, first entry long that failed, and I see small pushes below EMA, and I see push below EMA, and I give a second entry long that failed. This is a failed second entry long, and this is a great trap because this looked like a short-term uptrend and people are trying to go long on a second entry long. But since price pushed below EMA and the bigger pattern is down that has yet to reach a new extreme, you know that it's not safe to go short. You know that you're most likely going to get new low because the bigger pattern takes precedence, and this is a proven pattern. You don't need to question yourself whether you draw the trend line correctly. If you have 4 confirmations of this at the top and bottom, you know this is a proven downtrend. So once you see price creating a second entry long after uptrend played out below EMA, you know this is going to be a trap. And this was my 3rd trade for the day. Gorgeous entry. I took a 12 and some change point of a runner. I could have taken 15 right at the key level, but I decided to give it a little bit more room, and the market eventually reversed on me. So I'm glad I'm locked in the profits. Why did I lock in the profits, and why I wasn't greedy? Because after price creates break, new extreme, and I'm at the low of the day key level, I can expect some sort of at least temporary bounce. So well, I'm going to be way too greedy if I can lock in at least something. If you're just going to push lower, okay, I'm still in the game and I'm still in this run. I took this trade based on 2500 tick chart. This was the entry right here, which I shared on the community post. New high, first entry long, pullback, second entry long. You guys can see that on the 2000 tick chart, it was a little bit undecisive, the setup, with the bullish bar, not the great entry, but on this chart, it ticked higher, instantly reversed, full bearish reversal bar. Perfect entry price action wise, perfect signal bar. And this was the reason why I took this entry on the 2500 tick chart. And still, new low is about to be expected, and key level of the day is being the target. So now that I have a break and a new low and I'm bouncing at the key level, price action trader expects at least temporary correction or possibly straight up reversal. You may even expect reversal, because the low of the day and the new low for the downtrend is probably going to tell you that sellers are no longer interested. But the downtrend was strong. This was the entire, from the market open, market just strongly pushed down. So you don't want to be trying to definitely reverse. You're just sitting patiently, and you want to go long only after you get a proven trend in the opposite direction and there is nothing, and you have a strong continuation of the downtrend. Okay, it's completely normal to get 2 legs to a new extreme, but when you have such a strong push down, this is how you're probably starting to realize that the downtrend is going to continue, because EMA keeps pointing down, you keep pushing lower. So what you can do at this point on, you can actually find a slightly bigger pattern. And if you don't have the pattern, it's okay. You just use it for bias confirmation, but you guys can see how nicely the trend line is confirmed. Okay, I'm just going to copy it, put it at the bottom. And I have a new low right here. I have a first entry short that failed, pull back, second entry short. But you're going short directly at the low of the day almost of this entire move. You're far away from EMA. You cannot take this entry right here. Then you get another bearish bar, but you don't get a trigger below. And look what you have. You have a small little consolidation right here. You have a sideways movement, and you have a push higher, failed breakout, and an instant reversal back down. This is a failed breakout out of congestion, and also this is a double trap entry. I'm going to mark this up as a high probability because the key entry point is holding price. EMA, you wouldn't have this trend line yet. This just set up the trend line, so you only have EMA, but it's a failed breakout out of congestion. Uptrend played out with the break and a new extreme form, and this is a double trap because the second entry short got stopped out, and everybody who went long too early got stopped out, and market reversed, big bearish bar, quick, easy scalp. I didn't take this trade myself because I was still a bit unsure. I should have pulled the trigger here. I was way too patient on this trade. But looking back, this was a fantastic trade. Take a look what you have. Additional move down. And now it's starting to be really suspicious because you have a first leg, pullback, and a third leg to a new extreme. So once you see a 3 legs to a new extreme, that's most likely not really a thing. That means that there's a bigger downtrend. And this is where you discover the bigger pattern and you're just looking for shorts. You have a second entry short, but the short-term uptrend is in play. So even though this works for a scalp, you cannot take this short just yet. But once you have a lower high confirmation of this 2-legged pullback, this is a great entry that you want to consider taking. You get a little bit of a, not the best signal bar, it's a little bit doji bar. So that's the reason why you can be hesitant here, because this bar is not really showing that great of a bearish momentum. But it's the first break of this downtrend. Attempt to new extreme is anticipated, and it is a lower high that confirm this second entry short with the break and attempt for a new high of this uptrend. Price consolidated from that point on. So once you see EMA flat like this, you're sitting patiently, market is pushing higher, and take a look what you have. Confirmation of the key entry point. So this is where the high probability setup will occur. So tested the low of the day, and notice how the low of the day is so important. It really comes into play all this way down here, all this late. It is a breakout pullback area. The low of the day, you guys can see how it is holding and it's being tested. So you guys can see how strong these key entry points are. So only thing you need to do is learn to read the price action, and really the simple trend line will give you and generate high probability setups. It is better to wait for a lower high or failed second entry long, but you get a lower high here, but this is a horrible signal bar and you don't get no failed second entry long. So you just have to be patient, and you have a break, attempt to create new extreme, and you guys can see how EMA is starting to get flat. It's no longer pointing lower, and you can start to switch into trading range rules. Still, the bias is bearish because you traded down into this trading range, and you still after a break expect new extreme for the bigger pattern right now. So there's a market working higher, price working higher, break, attempt to create new extreme, and a lower high. Had this signal bar been better for a lower high, this would be a great entry because the resistance is holding, and you expect, according to trendline rules, new extreme to be formed, but the market is pushing lower. And when you see market pushing lower like this, you reset the count at the top, you have a first entry long, and once you see pushing below EMA, you expect for second entry long to appear. You want to jump on board to sell to get a new extreme, and you get a second entry long failure all the way far from EMA, all this low, cannot be entered, unfortunately. Market created the new extreme for the bigger pattern and for the shortened trend line as well. Okay, so that means that it's time for correction or straight up reversal. But when you zoom out like this, 100-point move downtrend like this is not going to get reversed instantly. So you have to keep in mind that just because you have a new extreme, when the downtrend is so strong, you're most likely not going to get a new reversal just yet. You're always safer to assume that you're going to get multiple legs to a new extreme. It's always better to afford missing few losing trades than trying to go long too early, in my opinion. Here we have an interesting trade. We have a new low form, we have a first entry short, second entry short failure, and a new high, first entry long, second entry long. This entry is a good for a quick easy scalp, and I will actually mark it only because it is a second entry long at the same time. If this was just a failed second entry short, I don't think it would be strong enough to just reverse this entire downtrend. But since this is also a second entry long, it's such a nice big bullish bar, you know you can most likely get a quick scalp. I really was hesitant, but now you can treat it as a trading range. You guys can see that we've been move down, move up, move down, move up, move down, move up. So this is a trading range. EMA is getting completely flat, and with the fact that you have a new low, you have a triple bottom, triple top. So expect for price to go from the bottom to top as well. So decent entry, you have a break, new extreme form. But once I see this is the bias that I want to stick to. I see that the overall bias was bearish. I see that the price is failing to reach the top, so potential bearish imbalance. I see a strong push below EMA, and I have a new high, first entry long, pullback, second entry long below EMA. Perfect entry context wise because uptrend played out with the break and new extreme. Overall pattern is down, but signal bar, half of the bar is a bullish stim, unenterable. But the context wise, this entry was perfect. If we take a look at 2500 tick chart, we can see that this was the entry. You guys can see how perfect of a signal bar. It wasn't that perfect, but it was much better. First entry long, second entry long, failure below EMA, while the uptrend played out with the break and new extreme. So perfect range rules, perfect trap. You just wait for price to create a break and new extreme, and then you look for reversal. So now that you see that the market is pushing lower, you're fully playing trading range rules and you're fully focusing on the short-term trend lines. So you have a break new high. You guys can see the price is failing to reach the top of the resistance of the trading range, indicating possibly bearish imbalance, and especially with the overall bias you traded down to, you expect for price to break down because the way you trade into trading range is most likely how you're going to break down. You have a new high, strong push below EMA, indicating bearish momentum. This uptrend played out with the break and new extreme, and you have a first entry long that failed and a little second entry long on a micro level, and you have a first entry short, second entry short. This was my last trade for the day. I tried to take the second entry short and failed second entry long. Great reversal bar. Take a look. Bar traded higher, and at the end of the bar, everybody started selling, indicating strong bearish momentum. A simple price action, two-legged pullback, uptrend played out. All the context is on your side. You can afford to wait a couple of hours for this perfect setup. Once I dropped my limit order, it instantly reached the scalp, and then it reversed, and I could have even left the limit order, but generally once it reaches 8 to 10 ticks, I tend to exit it because you don't want to get too greedy. Once it reaches the scalp, it may reverse, but this was a great entry. EMA kept holding price key entry point, and market just never looked back and continue pushing lower. Okay, so once you see price pushing lower like this, bearish momentum, this is a full-on downtrend. Once again, you're going to zoom out to remind yourself of the structure. This is the structure, so no bottom pick, nothing like that. Simple price action following the rules. New low form, first entry short, second entry short, not touching the EMA, doji bar, and the short-term uptrend is still in play. So when you see this, you expect the good old double trap. You expect for traders to get trapped going short too early, and you expect, look at this bullish reversal bar. Felt second entry short, tick lower, instantly reverse, big bullish bar, great entry, but it's going long directly into EMA, directly into resistance in a strong bearish downtrend. You know everybody just got trapped. So this is the double trap. They both got trapped going long or short too early. Unfortunately, look at this stem. Gigantic. This is unenterable. So you just have to watch here. But context wise, this is a perfect entry. Then you have a double top, push lower, lower high entry. Good enough. Context wise, perfect. The signal bar, neutral. And you really should, on a lower high, you can afford to have a bad signal bar when you're at the key entry point, when the setup is good. But lower highs and failed breakouts should generally have good signal bars. And the market just headed into a close. You guys can see how strongly we're selling off. This is at the very close of the market, and you don't want to be trying to enter once the market is about to close, because if you make a mistake, you don't have a chance to make it back. And a lot of traders are just taking a profits, and there's not that much of a volatility. So don't even push it to the later hours. Be satisfied making the money early on. So this is how you trade following the price action rules. But a lot of times today, the setups were great context wise, but signal bars were bad. This was at least like 5 setups today had to be skipped because of a bad signal bar or bad money management system, because the signal bar was just way too big. But overall, context wise, decent entry if you're willing to wait for a couple of these entries. So I'm going to see you guys in the next one. Take care, everybody.